to those of you that have seen our previous videos. My name is Ryan Boyd and I'm one of the directors at Integra Financial. Within this training video I'd like to cover off product features or benefits, as it were. There's a lot of features that lenders impose within their mortgages to be of advantage to you as a client. I want to cover off a few basic ones just to give you a bit more insight in terms of how they work and how they may benefit you. So let's start off with overpayments. Overpayments simply give you the ability to pay back more than what you're contracted to pay. So you can repay your mortgage debt faster, which will reduce your capital balance and the interest being charged against your mortgage as well. So let's assume that you've got a balance of £100,000, you're paying £500 a month, you've got £1,000 that you wish to overpay on your mortgage, you make that payment of £1,000, your capital balance reduces down to £109,000, and then what will happen is your mortgage payment will be readjusted accordingly. Lenders will charge interest on your mortgage payment either daily, monthly or annually. Now let's explain that a little bit further. Daily interest rate calculation simply means that your interest is calculated daily and will be changed daily. So in that example I've provided with the overpayment, if you make an overpayment of £1,000, the lender will recalculate the capital balance as well as the interest charged immediately. If you were being charged interest monthly, they would recalculate at the end of the month. With annual interest rate calculation, they will recalculate at the end of the year, which means your £500 payment will remain the same up until the end of the year or the anniversary of the product and then be recalculated. Always check your illustrations that are provided by the bank, building society or your advisor for clarity on the interest calculation. With overpayment facilities, lenders will generally allow you to overpay up to 10% off the mortgage per year. That's not always the case. Again, check the illustration, but that's a common feature within most mortgage products. To break that down a little bit further, it's important that you double check whether that overpayment facility, using the 10% as an example, is 10% of the original mortgage balance borrowed with that lender, or 10% of the balance remaining on the anniversary of the product. As soon as you step over the overpayment facility, then you may be charged an early repayment penalty, so go careful with that. As I've mentioned already, the overpayment facilities vary on lender to lender, so check the illustrations for further clarity and detail. So that's overpayment. Let's look at the other end of the spectrum, which is underpayments. Underpayments gives you the ability to either draw back partially or fully on your next or subsequent mortgage payments. Generally, lenders will only approve an underpayment if you've held the mortgage for a period of at least 6 months, so showing that you've kept your mortgage up to date, and or if you've previously made an overpayment to put yourself into a positive with the account. Otherwise, if you've not made any overpayments during the time of having the mortgage and you wish to underpay, you're basically owing the lender more money back. Again, double check the illustration and check with your mortgage advisor for further clarity. One other feature which is relatively similar to underpayments is payment holiday, which means that you can either partially or fully not make a payment for an agreed period of time that you agree with the mortgage lender. Once again, lenders typically want to see that you made an overpayment previously to put yourself into a positive within your mortgage account. Hopefully that makes sense. Other features would include portability or porting, as it were. Porting basically means you can port or transfer your mortgage from one property to another. Lenders don't usually allow this if you own one property and another already. They won't do inter sort of property changes. But let's say, for example, you were selling your main residence now and looking to buy another property, and the mortgage you had on your current property you were still tied in with. You don't want to pay the penalty. So the option to port the mortgage means you can pick up that mortgage, transfer it to the new property and avoid any penalties. There's a couple of things I'd like to stress on that. It's very common with existing clients that I speak to, they think they can literally just pick the mortgage up and transfer it over. Unfortunately, that's not necessarily the case. Even though your circumstance and the lending amount would maybe remain the same as to what it were when you applied for the mortgage, remember market conditions have moved on and lenders have moved on. So you would have to reapply for those porting money, so reapply for your existing mortgage. which means that you're subject to the lender's criteria at that time by way of property suitability as well as income and affordability suitability, so making sure that you meet the lender's criteria and demands. Consult a qualified mortgage advisor or the mortgage provider that you're with for further clarity and detail on that. That's pretty much it. There's a huge level of options that lenders may provide you with mortgages, and the mortgage market is evolving day by day, and no doubt there'll be new flexibility models offered within new products. But for now, hopefully that gives you a general overview of what's available, how they work, and things to be aware of. Thank you again for watching. We appreciate your time. Look forward to seeing you soon. Bye-bye.
Oh, teach me, Master, Master, teach me, for I would not